think certainly when we think about the impact of tariffs on the economy, we go back to the playbook that we had in Trump 1.0. And we saw that actually back then, you didn't necessarily have a calamitous effect on global growth, such as some of the forecasts from the IMF, or necessarily on the growth pattern in the US or its major trading partners. In many ways, even major trading partners like the EU, China, Japan, and others navigated this quite well. Nevertheless, we're at a very different part of the cycle, of course. And so something I would highlight there with regard to the fiscal side of things is that we're in a very different situation with regard to the fiscal deficit in the US, with regard to household budgets that you mentioned, particularly those on the vulnerable side of the income spectrum, where credit card delinquencies continue to hit a series high for the Philadelphia Fed. And companies, of course, are if they're going back out to capital markets, they're going out at a much higher rate. So I would say we're in a much more precarious and vulnerable state than we were in 1.0. And as for the impact on the economy, I think many are poised to focus not only on the U.S. consumer, but of course on the impact on other trading partners such as Canada and Mexico.
From what we know so far, right, the tariffs that have been enacted, at PwC, what is the actual pass-through rate going to end up being, do you think, on average?
No, I think it'll be difficult to see. I think, firstly, with regard to, I think we have to watch on the corollary impacts, such as the steel and aluminum tariffs hitting the construction and home building sector. That's very clear, and I think that's going to have knock-on effects throughout the economy. Given that the shelter component is 1/3 of our CPI and we're at record high prices, that will be, I think, very, very concerning for the outlook for the economy going forward. If we also think about just the impact of the price increases on Canadian energy coming into the U.S., particularly the power sector in the Northeast sector, in the Northeast part of the United States, that's also very concerning. So I think Martin, really the focus has to be on these knock-on effects downstream rather than just the initial tariff announcements.
All right, fair enough. Back to Yale's numbers from the university, their budget lab, tariffs could represent a tax hike of about anywhere from $1.4 to $1.5 trillion over the next 10 years, which, makes me wonder in terms of the tax cuts that the Trump administration is going to be trying to get through. Do you think I suppose the idea is to try and offset the impact of tariffs? Are they going to be able to do that, do you think?
Martin, I always think about the longer term, and my concern is with an extension of the tax cuts is for where the deficit stands going forward. And so whereas in the short term, potentially tariffs can potentially raise revenue over the shorter term, we have to think about the longer term impacts. I have very serious doubt that this potential extension of the tax cuts will be paid for by dynamic scoring. We've already seen the Atlanta Fed's GDP now forecast for Q1 of this year plunged by 2.8%. So really, I think investors and market participants are reframing the outlook for growth in the U.S., which means, of course, you would have less tax revenue going forward. So I am quite concerned. I'm not necessarily poised that this tax reform will actually stimulate growth over the longer term. And of course, it will add to the fiscal deficit by a meaningful amount.